In the previous section, you learned how appraisers and brokers estimate value by looking outward to the market through comparable sales. The sales comparison approach asks, what have buyers actually paid for similar properties? And then uses that information, with adjustments, to estimate what the subject property would likely sell for. The cost approach takes a different path. Instead of looking outward first, it looks inward at the property itself and asks, what would it cost to build this improvement today on similar land? For a real estate salesperson, understanding the cost approach helps you in several ways. It gives you another way to think about value, especially when sales data are limited. It helps you recognize when older properties might be underpriced or overpriced compared to new construction. And it allows you to explain to buyers and sellers why an appraiser might rely more heavily on the cost approach for certain types of properties, such as new homes, schools, churches, or government buildings, where good comparables or income data may not exist. Cost approach defined. Imagine Bill, who is shopping in a new subdivision. He is torn between having a new home built from the ground up or buying a home that was completed just a year ago. To make a smart decision, Bill wants to know how the price of the existing home compares with the cost of building a similar home on a similar lot today. If the existing home costs more than what it would take to build a new one, he may feel it is overpriced. If the existing home costs less than current building costs plus land, it might be a bargain. The cost approach to value addresses exactly that question. It compares the value of a property with the cost to build a similar or functionally equivalent improvement on comparable land, using current construction prices. The underlying logic is simple. A typical buyer will not pay more for an existing property than it would cost to buy land and construct an equivalent improvement, assuming that is realistically possible in that market. In practical terms, the cost approach estimates market value by taking the cost to construct the improvements new, subtracting accrued depreciation, and then adding the current value of the land. In words, market value by the cost approach is generally estimated as the cost of the improvements today, minus the loss in value from age and obsolescence, plus the value of the land as if it were vacant and available for its highest and best use. Where the cost approach works best, and its limits. The cost approach is especially useful in certain situations. It tends to be most accurate for newer properties where the actual costs of development and construction are known or easily estimated. Builders often know exactly what it costs to construct a recently completed house, including materials, labor, and overhead. In such cases, depreciation is minimal and relatively easy to quantify. The method is also valuable for special purpose properties where the sales comparison or income approaches are difficult to apply. Think of schools, churches, fire stations, or uniquely designed public buildings. There may be few, if any, comparable sales. The property may not be bought and sold frequently, and it may not produce income in a typical way. In those cases, the cost approach can provide a grounded opinion of value based on what it would take to replace the building's utility. However, the cost approach has important limitations. It assumes that a buyer could readily find similar land and actually build a comparable property. In some areas, all suitable building sites are built out, or zoning and development restrictions make new construction difficult or impractical. The cost of land alone may have increased dramatically, even if construction costs remain stable. Accurately measuring depreciation is another challenge. Older buildings may suffer from physical wear and tear, outdated designs, and external factors such as declining neighborhoods or changes in surrounding land use. Estimating exactly how these factors translate into a dollar loss in value requires judgment and experience. Different appraisers may reach somewhat different depreciation estimates, especially for older or complex structures. Finally, the cost to create an improvement is not necessarily equal to market value. An owner can always overspend on features that buyers do not fully value. a high-end kitchen, an elaborate home theater, or custom finishes may cost far more to install than what the typical buyer in that neighborhood is willing to pay. For this reason, the cost approach is often viewed as providing an upper limit to value rather than an exact reflection of what the market will pay. Benefits of the cost approach. Despite its limitations, the cost approach offers important benefits. It can help reveal whether the existing housing stock in a neighborhood is undervalued or overvalued when compared to current construction costs. If the cost to build a new home is significantly higher than the prices of similar existing homes, that may indicate that current resale homes are relatively inexpensive and perhaps undervalued. On the other hand, if existing homes are consistently selling for much more than the cost to build new, that could suggest an overheated market or that buyers are willing to pay a premium for location, character, or scarcity. The cost approach also serves as a useful cross-check against other methods. If the sales comparison approach produces a value estimate that is very different from the cost approach, the appraiser may need to revisit assumptions about comparable sales, depreciation, or land value. Having a second or third method allows the appraiser to triangulate a more reliable final opinion of value. Returning to Bill in the new development, he might ask the builder or his appraiser to estimate the cost of constructing his preferred floor plan on a standard lot. He then compares this estimate plus land costs to the asking prices of existing homes in the subdivision. If the existing home is priced well above the cost approach indication, Bill might question whether he is truly getting a good deal. If the existing home is priced below what it would cost to build new, that may support the asking price and reassure him that he is not overpaying. Types of cost in the cost approach. When applying the cost approach, the appraiser must decide which type of cost to estimate. There are two main concepts: reproduction cost and replacement cost. Reproduction cost is the cost to construct, at today's prices, an exact duplicate of the subject's improvements using the same materials, design, and workmanship. This means replicating everything, including outdated or unusual features. Reproduction cost is sometimes preferred when precise duplication is important, such as with historic buildings or structures with architectural or legal significance, because it makes measuring depreciation more direct. Replacement cost, in contrast, is the cost to construct, at today's prices, a building that provides the same utility as the subject, but uses modern materials, methods, and designs. The new building does not have to be an exact copy. It simply needs to serve the same function with similar overall usefulness. Replacement cost is typically used for older structures, where it would be impractical, wasteful, or impossible to reproduce outdated features. An older home with plaster walls, obsolete wiring, and an awkward layout would not likely be rebuilt exactly as it stands today. Instead, a modern, functionally equivalent home would be constructed, and replacement cost captures that idea. For many residential properties, especially older ones, replacement cost is the more realistic measure because it reflects what a typical buyer or developer would build if starting from scratch today. Depreciation in the cost approach. A cornerstone of the cost approach is depreciation. In appraisal, depreciation means the loss in value of the improvements over time due to any cause. Land is usually assumed to retain its value or even appreciate, so depreciation is applied only to the building and other improvements, not to the land itself. Accrued depreciation is the total loss in value from all causes combined. Appraisers usually group these causes into three categories: physical deterioration, functional obsolescence, and economic or external obsolescence. Physical deterioration is the wear and tear from use, weather, and the passage of time. Roof shingles age, paint fades, mechanical systems wear out, and foundations settle. Some physical deterioration is curable, meaning that the cost to fix the problem is less than or equal to the value added by the repair. For instance, If repainting the exterior costs $3,000 and increases the property's value by $4,000, that peeling paint is a curable defect. Other deterioration is incurable because repair costs would exceed the value added. If repainting would cost $5,000 but only increase value by $2,000, the defect would be considered incurable from an economic standpoint. Functional obsolescence occurs when a property has design features that are no longer considered desirable by current buyers. Examples include a one-bathroom home in a market where most buyers expect at least 2 baths, or a house with an awkward floor plan and poor traffic flow. Functional obsolescence can be curable if the cost to update or redesign the feature is justified by the increase in value. For example, adding central air conditioning to a home in a hot climate might cost $10,000, but add $15,000 in value. It can be incurable if redesigning the structure would be prohibitively expensive relative to the value gained, such as completely reconfiguring a floor plan that is deeply inefficient. Economic or external obsolescence is loss in value due to adverse conditions outside the property boundaries. A once quiet neighborhood might decline due to increased traffic, nearby industrial development, changes in zoning, or the closure of a major employer. Because the property owner generally cannot control these external factors, economic obsolescence is usually considered incurable. Even a perfectly maintained home can lose value if the surrounding area becomes less desirable. Steps in the cost approach. The cost approach follows a logical sequence of steps. At a high level, the appraiser estimates the value of the land as if it were vacant, estimates the cost to construct the improvements, estimates and subtracts accrued depreciation, and then adds the land value back in to arrive at a final value indication. First, the appraiser estimates land value. This is usually done using a sales comparison approach applied to land only. The appraiser finds recent sales of comparable sites, adjusts for differences such as location, size, and topography, and derives an indicated value for the subject land as if it were vacant and ready for its highest and best use. The improvements are ignored at this stage. Second, the appraiser estimates the reproduction or replacement cost of the improvements. Several methods are available. In the unit comparison or square foot method, the appraiser looks at recent construction costs for similar buildings, calculates a cost per square foot or per unit, and multiplies that unit cost by the subject's size. In the unit in place method, the appraiser estimates costs for individual building components, such as foundation, framing, roofing, electrical, plumbing, and finishes, then adds them together. In the quantity survey method, the most detailed but also the most time-consuming, the appraiser itemizes all materials, labor, overhead, and profit to arrive at a highly specific cost estimate. This method is more often used by engineers or architects for project planning. Another option is the cost indexing method, where the original construction cost is updated using cost indexes to reflect changes in material and labor prices over time. Third, the appraiser estimates accrued depreciation. One common technique is the straight line or economic age-life method. This method assumes that the building loses value at a constant rate over its economic life. For example, if a structure has an economic life of 50 years and is currently 20 years old, it has used 20/50ths of its life. The appraiser can apply that ratio to the cost new to estimate how much value has been lost through physical deterioration. Other methods may be used to capture functional and economic obsolescence. Fourth, the appraiser subtracts total accrued depreciation from the cost new of the improvements to arrive at the current value of the improvements in their present condition. Finally, the appraiser adds the estimated land value to the depreciated value of the improvements. The sum becomes the indicated value of the property by the cost approach. For example, suppose an appraiser estimates that the land is worth $40,000. The cost to construct the main building and other structures new is $138,000. Total accrued depreciation from physical wear, functional obsolescence, and external conditions is estimated at $15,000. The depreciated value of the improvements is therefore $123,000. Adding $40,000 of land value produces a cost approach indication of $163,000 for the property as a whole. Practical application, cost information, and professional standards. In real practice, gathering accurate cost information can be a significant part of the appraiser's work. Colton, a new appraiser, is assigned to value a 3-story office building and parking lot that were built decades ago. He starts by researching public records, old building permits, and developer files to find the original construction costs. He discovers that the company that built the improvements no longer exists and that original construction costs from many years ago would not reflect current prices anyway. Colton then moves to market-extracted information. He studies sales of similar office buildings and interviews local contractors to understand current construction costs per square foot for comparable structures. He gathers data on recent land sales to adjust the site value and uses cost manuals and online services to refine his estimates. He consults tax guidelines and local property tax assessments to cross-check depreciation patterns. Throughout this process, Colton follows the uniform standards of professional appraisal practice. These standards require him to clearly separate land value from improvement value, to base his cost estimates on credible sources, and to account for depreciation in a supportable way. By combining actual cost data where available, market-extracted cost information, and recognized cost services, he arrives at a well-supported cost approach indication that can be reconciled with any sales comparison or income approach he also performs. Why this matters in the real estate contract world. For real estate professionals, the cost approach is not just a classroom concept. It influences real-world transactions because lenders and underwriters often review appraisals carefully. If an appraisal based partly on the cost approach comes in below the contract price, a buyer's loan approval may be at risk. Many purchase contracts include an appraisal contingency that allows the buyer to cancel if the property does not appraise at or above the purchase price, under terms acceptable to the lender. Sometimes a lender's underwriting department may require a second appraisal or an appraisal review. If the second value opinion is lower and the lender never receives an appraisal it deems acceptable, the appraisal contingency may give the buyer the right to cancel and recover earnest money, provided the buyer acts within the time limits in the contract. Understanding how value is developed, including through the cost approach, helps you explain to buyers and sellers why appraisals matter and what options exist if the appraised value does not support the agreed price. Review summary. In this section, you learned that the cost approach estimates property value by combining the land's value with the depreciated cost of improvements. You saw that the approach works best for new or special purpose properties and provides an upper limit to value based on what it would cost to construct equivalent improvements today. You distinguished between reproduction cost, which replicates the property exactly, and replacement cost, which creates a modern functional equivalent. You explored the 3 main causes of depreciation: physical deterioration, functional obsolescence, and economic obsolescence, and saw how each can be curable or incurable in practical terms. You walked through the steps of the cost approach: estimating land value, estimating reproduction or replacement cost, estimating accrued depreciation, subtracting depreciation, and adding land value back in. You also saw how appraisers gather cost information from actual, market-extracted, and published sources, and how the cost approach interacts with lender requirements and appraisal contingencies in actual transactions. Discussion. Why does the cost approach often set an upper limit on value? Answer. Because it is based on what it would cost to build a new, equivalent improvement using current materials and methods. In a normal market, buyers are unlikely to pay significantly more for an existing property than it would cost to buy similar land and construct a comparable building. If the cost approach estimate is much higher than what buyers are willing to pay, that suggests the market does not fully recognize those construction costs as value. When is replacement cost more practical to use than reproduction costs? Answer: replacement cost is more practical when the subject property is older or contains features that would not realistically be duplicated today. Instead of replicating outdated materials and designs, the appraiser estimates the cost of a modern building that offers similar utility. This aligns with what builders and buyers would actually do if they were starting from scratch. Why is economic obsolescence usually considered incurable? Answer: economic obsolescence results from factors outside the property, such as neighborhood decline, nearby land use changes, or loss of major employers. Because the owner cannot control these external conditions, they cannot reasonably fix the problem at the property level. As a result, any value loss from these changes is considered incurable. How does the straight line or age life method estimate depreciation? Answer: the straight line method assumes that a building loses value at a constant rate over its economic life. The appraiser divides the economic life into equal segments and estimates how much value is lost per year. By multiplying that annual depreciation by the building's age, the appraiser estimates total accrued depreciation due to physical deterioration. Closing remarks. The cost approach gives you another lens through which to view property value. While the sales comparison approach looks to the market and the income approach looks to cash flow, the cost approach looks to the cost to build, adjusted for the realities of age and obsolescence. As a real estate professional, you will not calculate the cost approach in detail for every listing, but understanding how it works helps you interpret appraisals, analyze new construction versus resale pricing, and advise clients in markets where comparable sales or income data are limited. It also deepens your appreciation of how physical condition, design, and neighborhood change can affect value over time.